Hey, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Pulse for Friday, March 4th, 2022. We hope you're all having a great week. Not a lot has changed in the world since we spoke to you on Monday, but we're back with another update to tell you what we see in this market, give you the most transparent look that we can give you into our strategy, and more importantly, how do we see this playing out for investors. So we'll start with the chart like we always do. I'm not going to spend a lot of time on this today because not a lot has changed, but here's our NASDAQ 100 index, right? We know we had the onset of the correction, a big capitulation selling climax January 24th. We get a relief bounce. We go for another retest, right? And we talk about how markets can be very cruel from time to time. So they know that this line in the sand from that January 24th low is a key level for a lot of short-term investors. They push markets below it. We get some forced selling. We get a lot of people that just totally give up on everything that they own. And then boom, buyers reemerge. We're back above it and we have a short-term rally. Now we're backwardating a little bit. That is okay. You know, bottoming is a messy process. It tends to put a lot of emotional stress on investors. We understand that because what happens is a lot of investors remember the March 2020 low, right? And they look at these periods of time and they say, well, Mike, you know, this was a V-shaped bottom, right? Just down and up, right? Easy as can be. And yes, V-shaped bottoms are great. We love them. We take them every time we can get them, but that's really not generally how bottoms play out. We tend to see bottoms to be much more messy, where markets try to put pressure on people, and we're right now chopping in an area that is constructive, right? There's really no two ways to put it. This is constructive action. We love green days as much as everybody else. We hate the red days, but they are all part of this process. And what's more important is a lot of this is happening. Let me see if I can draw this in here. Fix that. This is all happening on declining volume, which means we are running out of sellers. And I think buyers, which are being very patient, like ourselves, kind of just sitting on a rules-based approach and saying, you know what, today's Friday, we're not going to buy into a weekend. News is quickly evolving. So we think there's a lot of buying interest at certain levels in the market, and we believe that we are running out of sellers. So we had some other information that we wanted to share with you today that we think will frame this and put this all in perspective. So number one, right now everybody's distracted by Russia and Ukraine. And again, I've talked about this. That is a humanitarian crisis, but it is not a financial one. And what happens from time to time is when markets get distracted, right, they take their eyes off the wheel and they start paying attention to other things, and they miss some really good things happening in the economy. For example, February jobs report this morning showed an increase of 678,000 jobs. Economists expected 440,000, right? So a nice beat. Continued employment growth. We want to see more people getting back to work, more people with good, high-quality jobs that they can go to. But the market didn't even react to this today. Why? Because it is currently distracted by non-financial matters. That's okay. Doesn't mean we miss the opportunity to rally on news like this. It just means that the gratification will be delayed. But eventually, this will work its way into the market, and the market will realize that there are good things going on under the hood. Another sign that we think is very encouraging that the markets are just totally missing right now is the message that the bond market is sending, right? So you remember how this narrative works. When the 10-year yield rises, it tells the Fed that they need to be more aggressive in raising interest rates. When the 10-year yield falls, it suggests to the Fed that there's no need for some crazy aggressive and hawkish policy, right? So on the way up, as yields were rising, stocks were getting battered because, right, rates go up and we're going to have to sell everything. That was what we were told. That's not what history tells us, but that's what the media told us, so it must be true, right? I guess we'll find out. But over the last couple weeks, we think yields have topped out as different things around the world, the war included, have developed to send the message to the Fed that maybe this aggressive policy is not really as necessary as we thought, and yields have started to fall. Now, again, everybody's distracted right now with their eye off the ball, so nobody's noticing this, but this is another thing added to the good jobs numbers in this that we think the market will eventually come around to realize that these facts are pretty good and they need to be priced into the market in a positive way. So aside from yields and the bond market, which is 3 times the size of the stock market, sending us a signal, what other signals may we be able to find? So we look at our heat map, right? And we look at the different areas of the market. Now, if you went up to a random investor on the street and said, you know, what do you think the markets did over the past week? I think everybody would say down, right? Because that's the mood that investors feel. It feels negative, it feels sour, everybody's pessimistic. This is the heat map over the last week in the market. So number one, you're seeing a lot more green, which is a good sign, right? Markets are really firming up in all different sectors across the market. But there's another interesting message that's being sent that a lot of investors are missing. And if you look over the last week, what area has gotten hit very hard? Financials and banks, folks. And what message is this sending? What message is the market screaming out that nobody's listening to? That interest rates are not going to go that much higher, that much quicker. Okay. Again, we do think there will be rate increases this year, but I think that the expectations of the market have significantly overshot those increases or those expectations of 6 or 7 interest rate hikes. We think we'll see 2 or 3. And again, if you overprice something in and the reality tends to be less severe than anticipated, that will be bullish for the market. We have some other information we want to share with you today. Some really good charts from some friends in the industry, some different researchers that we wanted to share. So the first one actually comes to us from Bloomberg, okay? And what we're looking at here is what we call short interest. Now, for those of you that might be more novice at this, when an investor goes short an asset class, they're betting on that asset class to fall. So what we're showing here is the level of investors that are short technology, right? And if we look at this going back to really in 2017, we are seeing extremely high levels of people betting against this market. But Mike, that sounds like a terrible thing, right? If everybody's betting against the market, shouldn't I be betting against the market too? Well, unfortunately, markets are cruel, markets are mean, and when the whole herd goes one way, you can bet assured the market's going to go the other way, right? And history tells us that. Now, history may not always repeat itself, but history tends to rhyme a lot, and we like to lean on these types of data points and figures to get an idea for what is everybody else doing. And in this case here, everybody is preparing for a crash, and this is not how crashes start, folks. So the time to be going short was 15% ago, 20% ago on the S&P 500. Not here and not now, but again, many investors will do the exact wrong thing at the exact wrong time and compound their errors. So not our folks, we won't let it happen to you, but we wanted to share this with you today. Let's look at another chart that we think is very important. This is taking the previous data we just shared and putting it in a logarithmic pattern, right? So we're looking here at the S&P 500 up top and the value of puts, which is a way for investors to be short the market, to bet against the market. So right now, we're seeing a massive amount of put buying, right, which are options that bet against the market, massive amount of put buying, just while we see net short exposure hitting extreme highs at what we think is a market bottom. Now, if we look back, I know this might be a little hard to see, but anytime we reach these elevated levels of people betting against the market, what does that generally correspond with? Bottoms in the market, right? So again, history may not repeat, but it tends to rhyme. And so far, that's 2 for 2 with internal indicators we follow that are pointing to this being a bottom. Let's go a step further, right? There's some interesting things you can do when you bring together financial charts and social media sentiment. There's a lot of folks and algorithms out there and bots that scan social media for sentiment. So again, this is something we like to look at is what is the market doing and how are investors talking about the market. So this is data compiled from Bloomberg and Twitter, looking at different events geopolitically that have occurred going back to 2015 and how the markets reacted, right? So generally, anytime you get a sell-off in the market, right, markets go down, you get a spike in negative sentiment, right? Naturally, everybody feels pretty crummy, and they're talking about it on social media. And we're seeing extremely elevated levels of negative and pessimistic sentiment here, corresponding with, once again, what we believe to be a pullback low in the market. So we thought that was interesting. We wanted to share. And let's go a step further. Right now, we talked about this in a previous video. I didn't have the graph handy, so I wanted to share it with you today. So we talked about the bottom, right? We just brought this up. I talked about how bottoms can be messy. They're not all pretty and V-shaped like the one we saw in 2020. But nonetheless, let's look at this. And the thing about markets, folks, is, right, everybody wants to be a market prognosticator. Everybody wants to be a technician, but nobody takes the time to look back and be a market historian, right? Let's look at how the markets behaved in other times of geopolitical conflict or other corrections or other sharp pullbacks. But nobody does that, right? Everybody is concerned about the 6 inches in front of their face without getting any perspective on the situation. So that's what you have us here for. We're going to give you that perspective, and let's take a look at this. So we picked two particular instances in the Nasdaq's history that we think are very similar to what we're seeing here. We have the Nasdaq in 2011 and the Nasdaq in 2016, right? Both are bottoms, both represented fantastic buying opportunities. Both look a little bit different, but some similarities to right now. So let's take a look at it, right? The first part of the correction is always that cascade, that waterfall, that where it comes on, the onset of it, nobody saw it coming, and then boom, you're right in the middle of it. And here the market chopped around in this level for the better part of 2 months, right? A lot of head fakes, some relief bounces, some retests, just wearing investors out, forcing people out of this market, right? Because again, the market's not your friend. If everybody was able to make money easily, everybody would do it. But unfortunately, we know that making money in the market is not reserved for the masses. It's reserved for people with a precise strategy that they can stick to and strip the emotions out of it. So markets chopped around in this level. We had one retest and a lower low, right, which is similar to what we just saw last week. And then the markets bounced off that, one more retest and a higher low, and boom, off to the races. Okay, great. Same thing here. NASDAQ 2016, cascading waterfall. You get the relief bounce. Then you get that retest where we go below that line in the sand, right? Folks, does this look similar? Down, up, down, and here. Okay, so if history is a guide, and if these similarities that you're seeing through these charts and the data points we're sharing with you are telling a story that we believe, then this market is firming up and it's getting ready to go higher. So if this was 2016 overlaid on 2020, we would be roughly right here, right now. Now, again, that doesn't mean that the market's just going to take off, up, and away from here, but this would have been the point in 2016 where it would make sense to be a buyer, and yet here we are in 2022, and everybody right here wants to be a seller. So again, we've seen good action in the market. This rally off the lows was about 12% in the NASDAQ. We have given back some of it in the last 2 days, which is very normal, right? You just have a void of buyers right now. We're very bullish on the market, but we're not buying today. You have a weekend coming up. News changes a lot. So you have a lot of folks and institutional investors like us that are not buying. We believe a lot of sellers are getting exhausted. They're being flushed out of this market. And eventually, when you run out of sellers, the imbalance between sellers and buyers is going to shift back to the buy side. So even with the market about 6% off its lows from last week, we're seeing a lot of growth, tech, and software stocks that are up 10, 12, 15, 20% off their lows. So that's a good sign. You want to see the battered stocks that led down be the ones to lead our way out of it. But we wanted to give the perspective to you. And the thing that we really want to point out to you, right, is a confluence of factors. So one particular indicator in the market is not enough to be bullish. But when you have 1, 2, 3, 4 indicators lining up, all telling the same story, plus a good jobs report, and plus yields that continue to fall, which is signaling the bond market is screaming out, but nobody's listening. The Fed's not going to be as aggressive as expected, but no one's paying attention, right? But we're paying attention. So we're going to get through this. I know a lot of you feel that, well, the message really hasn't changed, Mike. You've been saying this for 30 days, for 45 days. Folks, bottoming is a process. I'm telling you that I believe the bottom is in. We believe the bottom is in. Whether or not we're going to retest it once, twice, 3 times, 6 times, 9 times, that's anybody's best guess. But all we can do when we believe a bottom is in place is try to buy in measured steps. Buying the bottom, buying the dips is not about buying the exact pinpointed low, right? If everybody could do that, that'd be great. But nobody knows exactly where it's going to be. It's about buying in a range and buying with a forward-looking view on this market where we believe we're buying high-quality companies at discount prices. And again, that's the one thing about dips in the market. Everybody wants to buy the dip, but few people successfully do it. And why are few investors able to successfully buy the dip? Because the dips in the market come with some very difficult, stressful emotions that create a lot of headwinds for people to buy, right? And I've always said it, when the time comes that you should be buying, you probably won't want to, right? And this time is no different. So if you have any questions, please reach out to us. We're always here to talk to you about anything that's on your mind. I've had so many great conversations with a lot of you folks this week, but we're here for you. We want you to know what we see. We're still bullish on this market. We will get through this. So if you have any questions, reach out to us. We hope you have a great Friday and a great weekend, and we'll see you back on Monday for the Heritage Market Update. Take care.